it depends on which rules you're talking about. There are two entities or two things to consider. One is the functionality of the loan itself and how it works. The terms of the draw period, which is the point at which it's open-ended, and then what happens after the draw period is established by the contract that's signed. And so a bank can't renege on that.
Yep.
Right. And so whether it's an open-ended line of credit that's secured by your real estate and it functions this way for 10 years, and then it functions this way for 20, or it functions this way for 30, that's a given.
Okay, so there people are signing documents that say like over 10, 15, 20, 30 years of this is how this product's going to work.
Yeah, it's a mortgage document.
Okay.
And so we do a lot of work to differentiate from mortgages, but the reality is it's a mortgage in the same way that if a bank holds your amortized mortgage in-house, they can't change the terms of that contract.
Okay, so with the first lien, this is good for me to know. With the first lien, people are signing documents that pretty much say like, hey, these things can change, but there's certain things that are going to stay the same for 30 years.
Yep, it's open-ended. So
open-ended for 30 years.
So our particular product's open-ended for 10 years, and then it has a 20-year payback period, which it's closed-ended, which
could be.
It turns into a closed-ended loan at our particular bank, right?
Okay.
It turns into a closed-ended loan for 20 years. And so the ability to access funds stops at 10 years if you don't get another first lien HELOC. So
so you could refinance it from there?
Yeah, you can.
But when you refinance it, is there more fees tied to that?
Yeah, there are. Because, and so that's another piece to consider too. Yep. This loan is a refinance. So when people say the word HELOC, they think of second lien HELOC, which I'm opening up a line of credit on top of my mortgage. Well, here's what that transaction looks like. We call the bank, and I'm generalizing, but we call the bank and I talk to maybe a teller, and I say, hey, I want a second lien HELOC. And say, sweet, what's your address? Give me some information. How much money do you make? I tell you how much money I make, and they probably believe me, and they type that in the thing, right? And then they, we're going to run an appraisal. Well, they click a couple buttons and order an automated appraisal that uses algorithms that are available, but no one's going out to the house, right? The closing is they send you some closing docs and you sign, and it's fine. So compare that to a mortgage refinance, just like a mortgage purchase, where you're applying, you finish a complete application. There's a hard credit pull. We ask for a bunch of docs. There's a full appraisal. You have title. You've got state fees that are all associated with this. And so the transaction for a first lien HELOC, because you're replacing the mortgage that you have already, is a refinance. And so for me, in terms of closing costs, they're prepaid too, but in terms of closing costs in particular, the way I like to think about that is people have to do work to get the transaction done. You got to pay people to do work to get it done. Yep. And so you've got the bank that has to do work. There's bank fees. You've got the appraisal. You've got the title fees and the state fees. For us, when people come around and they want to refinance again into another first lien HELOC, we waive the bank part of that. That's the part that we can control. Yeah. But then the appraisal, title, and state fees are still applicable at that point in time. So for our particular scenario, that's the case. Sometimes you can find banks out there that will waive those fees. My opinion is that they do that because everyone assumes that for HELOCs, it's supposed to be free. So they wouldn't choose it. They wouldn't choose a first lien HELOC if it weren't free. So what they do is they either eat those costs or they have their title company eat some of the costs too. Reality is the costs are still there. But what they'll do is they'll impose a prepayment penalty where if you get out of it, because basically they have to earn earnings at that point. So I know that went down a little bit more of a rabbit hole than... No,
I appreciate you mentioned that, and it actually proves my point that it wouldn't be very smart for you to have an open-ended loan in perpetuity, because it would be a potential risk to the investors that say, if we ever want to get out of this thing, we're essentially like, Anthony's got to die before we get out of this thing. And that could create bad incentives.
Another way, ours is structured to have a 20-year payback. So if you pay down the loan, whether you owe $20,000 after 10 years or whether you owe $250,000, it spreads over a 20-year payoff period.
That's okay. It's amortized?
It's an amortized.
Okay. Is it amortized or?
It's amortized, but it is a variable rate product. So it's sort of your ideal, from a government standpoint, ideal product.
Well, minus that it's variable versus fixed.